So we got all their basic information there, and we talked about the refund not being taxable. So let's go to page 66. There's a W-2 there for Jennifer. Okay. And she's working for Sears Roebuck. Does anybody remember the catalogs? You couldn't wait for Christmas for the new catalog to come in the mail. Mm-hmm. Oh. Okay. All right. And we had the wages for her, 10,000. And we had her withholding. All right, nothing in box 12 or 14, but we did have some withholding on the state for her. Okay, so we have that one in there. We're not going to worry about the goodwill right now because it really doesn't impact anything. All right, we had some interest income. So Val, where does the interest income go?
On the Schedule B.
But
not on the Schedule B.
That's right, okay. So we go into the Schedule B, we get our little interest statement that we have. So you can see it up there on the screen, okay. Remember I said that's why I handed that thing out, because you won't always see the little 1099 INT with the little boxes. You might see it as interest on the front page of a brokerage account like we see there, okay. First National Bank. And this was just regular interest, $321. We didn't have any tax withheld, okay? So we're good there. Now, Smith and Barney, okay? Capital gains, where's it go, Tim? On the Schedule D, but not on the Schedule D. So we're going to go into our Schedule D. Again, wonderful little form. We can go down into one of the boxes that has the link. We'll bring it up and get our capital gains worksheet. All right. We have micro stock. Okay. But in this micro stock, what category did we put it under? We have no date acquired and no basis. All right. But what's it tell us back in our little bio sheet? They had micro stock purchased September 17th, 1979, and it had a basis of 6,200. Okay, so is that short term or long term? Long term. And did we know, was the basis reported to the IRS on our 1099-B? No. So we're going to put that under what category? E, right? Okay. And what did it say? September 17th? 79, was that right? Yep, okay. And we sold it on May 3rd of 2015. All right. We sold it for $5,900, and we found out that it had a $6,200 basis. So we should have a $300 loss on that one, okay? We had another stock from SBC stock, so we can just keep right on our little capital gains worksheet. What category did this one fall in? If we had to pick A through F, what did anybody have? Long-term basis reported, so we got a D. All right, it was purchased 7/13/84. Yep, letter D, right? Long-term with the basis reported. 2015, we sold it for $55.62, and our cost was $48.68. Okay, so a little gain on that one. We did better there. All right, now we have Vesto Wireless We bought it in December of the prior year and sold it in October of the current year. So what does that make that one? Short term. We held it less than a year. Okay, and the basis reported, so we got an A. All right. We acquired it 12/24/2014. We sold it 10/24/15. And when we sold it, and our cost basis, apparently this was not a very good wireless company. Wireless companies do better than that. So we sold it for a loss, correct? Okay. All right. Now, what's the last thing we had? How'd anybody do figuring out Social Security?
I had to find a paper worksheet again.
Don't you hate that? So, Social Security benefits, we'll just kind of go through it here. We go to page 1 of our 1040 on our income. Obviously, our Social Security coming in is income. Social Security benefits, okay? We'll talk about them a little bit more when we do retirement, but our Social Security benefits. So we have that on line 20. Find our little link. Guess what? Social Security worksheet. All right. You can see scholarship income is up there at the top, but the second part down says Social Security and Railroad Tier 1 benefits, okay? So Social Security was received by Stanley. He had $12,600. All right. He had, if you look under the part down here, it talks about Medicare's Part B, C, and D to Schedule A. So it's one of those things where if we put it in there, since we can itemize our out-of-pocket medical, if we put that in there for the Medicare, it'll carry over there as part of our itemized deductions if we can use it. Okay? So we're going to put in there the $416, which is a bargain. Medicare is not that cheap anymore. All right, and he had $300 withheld. Okay? All right. Any questions there?
I didn't see where you put the Medicare part into Medicare.
What's that?
I didn't see where you put your 416 Medicare.
On the worksheet, did you end up on the worksheet? We got Social Security received this year. Okay. See about 4 lines down, it says Medicare is Part B, C, and D. So that withholding that's on there, it'll go right in there. And then it'll carry, as it says, to the Schedule A. All right. And then we have the tax withheld. Okay. All right. Okay. And that was it. Was that on the forms? Because I had a new printed book. Did I miss anything? We had 3 stocks. And withholding. Okay. And okay. So what are we missing on there? Got their income, got that. Nothing there. All right, did I miss anything? Did I have any sheets that weren't on there? Capital gains, I got those in there, right? Correct. 59.62. Proceeds, cost, proceeds, and cost. And then did I get their Social Security in there? And agents. Okay. If you take a look here, and like I said, we'll get to when we do itemized soon, okay? If you take a look, on the Schedule A where we itemized, you can see where our medical came over. Okay, so on the Schedule A, it shows up in there. All right. And let's see, was there anything else on there? Nope. All right, we weren't going to worry about the itemized. Okay. Did I get everything in there? Did we just have 3 stocks? Is that it?
Yep.
Okay. And we're holding on there. All right, so what everybody get? So what'd you have?
It didn't come up on my drive.
Okay. Anybody else?
We got refund federal 1650
Mm-hmm.
and state refund 1160.
That's correct. That's what I have here from the information we have. Okay. All right. Gene, what'd you have?
I had 2153 for the federal and 1311.
That's what I have.
Yeah, I'm thinking there's something missing because when I did this problem yesterday with somebody because we had a long answer key, I feel like I'm missing some text sheet. What do you have on, start on your 1040, page 7. Or excuse me, line 7, okay? 1040, page 1, line 7. What do you have?
Mine didn't say.
Oh, okay. Anybody have it in front of them?
10853.
Okay. Taxable interest on line 8. Okay. Capital gain or loss.
Loss of 17.
Okay. Social Security benefits.
None counts.
No tax.
But you should have 1260 there. So what did you have for total income?
9,474.
Yeah, that's it.
Okay. All right.
Do you have the interest income?
I do the 321.
Yes.
That was the only one, right? They don't have enough to itemize. Seems like there's a tax form missing from when I did it yesterday.
66A.
Okay, we found the difference. We have earned income credit, Gene and I, and that doesn't.
You got 5.
Yeah.
Why didn't it give them the earned income?
66A.
What did I miss on the first page here? Yeah, because it should give them the earned income credit. Got their birth dates in there.
Answers now. I should print it out.
Yeah, 66A, 503, and you don't. And why is
Right.
that?
Yeah, that's what I'm trying to figure out what, why did it not do the earned income credit form? That is strange.
Yeah, I mean, he was too old to get it, but she wasn't.
It doesn't even default it. That's not more. No. That's strange. Married filing joint.
Yeah.
Let's try something here. No. Got their age right. Occupation should not matter. Married filing joint. You got the two of them. Two. They are New York residents. Oh. Nope, that shouldn't make a difference. E-file. No. No. That's not very reassuring. That is very strange. Oh, how am I doing? Helps if you put the wife's social security number in there. 21, I hate when there's no red fields because I don't have the red things because it changed the color. I'm going, what's missing here? I'm going, look at this one. There's something missing. So yes, 2153 and 1311 is correct for the EIC. Okay? That was driving me nuts. Because one of the other structures was going nuts because they missed the withholding on the Social Security.
Well, did you have the EIC on New York? You said it was
1311.
and I'm showing 1501 for the state.
Well, let's look at your page 4, your 201. There should be, yes, $151 earned income credit and state withholding of $1160.
1160, I'm at 1350. New York State tax rate.
Yeah, at the bottom of the W-2, wasn't the W-2
Oh, shoot.
1160, right?
Yeah, I screwed
You know, you put the federal in twice.
up. Probably.
All right.
Yes, I did.
Okay. So, moral of the story is, don't forget to put the wife's social security number in. She'll get upset with you. Okay.
What did the correct states?
All right. Okay. All right. Any other questions on that one?
1311.
2153 and 1311. Okay. All right.
I just have a question.
Sure.
I have one company when it said, it was a long term on page 68, but it doesn't say it went to the IRS or not.
Mhm.
It got the form. Because I put, code C, C down.
On your worksheet, which stock?
The Besto, what are those?
Okay. You had 2 dates, correct?
Yes.
What were the dates?
December 14, December 12 and 14, and then October 24 and 15.
So that makes it what?
Short term.
Was there a basis reported on the slip? On the 1099B?
Yeah, so I just assumed,
So you put A, correct?
I had C, so A would be, okay, I didn't read that.
Yep.
I saw it went to the IRS, I was looking, is that the important thing?
Yep, so that the reports, yeah. Because if the basis, sometimes they, and again, that's why I said the 1099Bs that we see in the textbook and in the problems, You typically don't see that. You just have to know is if it's on there,
Oh, okay.
on the 1099-B, that there's a given basis. That means, because that 1099-B has been sent to the IRS too, that you have the basis.
Oh, okay.
Okay?
Okay, thank you.
All right. And they're getting better and better. You know, was it 3 years ago that we had to start doing them like this? I think it was 3. That we had to start reporting them like this on the 8949s because of following the 2008 and all the markets and all the brokerage houses being investigated. So that's where we started doing them this way. And the first couple years, until the brokers were able to research and find the basis, you had a lot of them that fell in the C category because there just was no history. And there was a lot more work, like I showed you, to go on to Yahoo Finance, or what's the other one, Michelle?
Big charts.
Big Charts. You know, those are both good ones where you might have to look it up. Okay. All right. Any other questions on that one?
I don't understand how I missed the earned income credit. That was the difference. That's the
Did you, on your W-2, who did you check?
spouse.
Okay. And did you have her social security number in, or were you like me and forgot to put it in there?
Yeah.
On page 1?
Mhm. That's in there.
Okay.
It counts for the spouse,
Mm-hmm.
got a number for that.
And then did you go through the EIC worksheet? Page 2? I didn't go through it, so that's the only thing I could think of is, did we check a wrong box there?
So he must have did it, other Julie did it himself. So he must have checked something.
Social Security.
Mhm. Go back to your main info status. Main info. And go down to your file status. Here, I'm joint. All right. Let's see worksheet 2. There you go. One more. So you should have that.
That's when it comes in 321.
Yep, so that's good. Keep going down. Oh. Taxpayer's main home, taxpayer's spouse in the United States, you couldn't know. So they lived in the United States.
Ah,
Now hit enter. There you go. Yeah, so, all right, so he had answered one of the questions wrong on the EIC. Okay, so probably good thing that both of us did what we did, because it made you look at the EIC, because we knew that they qualified, but we couldn't figure out why it did not. And that's why I say that EIC, that's why we covered real early, because it's such a big credit. Okay? All right. Let's head to Chapter 8. Okay? Chapter 8, we're going to get into retirement plans, pensions, annuities, and Social Security. Something that we hope we all get to. Okay? So we're going to get that one. All right? Okay. All right. So we're going to start out, page 8.3. It says this chapter deals with the distribution of retirement funds. So really that's what we're going to look at all the different vehicles that we might have that we invest in for our retirement, or that we've contributed to, whether it be through a 401k or an IRA or Social Security or whatever it may be. We're going to look and see how, when those distributions come out, how they're related, okay? As it says, some plans are qualified, some are non-qualified, all right? So obviously, when we hear the word qualified, we're probably going to have a test, all right? We've had qualifying children, we've had qualifying dividends, we've had qualifying relatives, and each time we hear that term, what do we usually have? Some type of little test to make sure, on it. So we'll see what it says about it, all right? Objectives here, we're going to talk about the taxability of pension, annuity, IRA, and other retirement plan payments. The taxable and non-taxable portions of Social Security. We'll kind of show you a little bit on railroad. I'm not going to go into it real deep because if I do, it kind of clouds the Social Security, okay? Don't see a lot of those. I did see a lot when I was in Akron because of the railroad out there, but you just don't see a lot of them anymore. But we'll kind of go over them just a little bit. We'll talk about taxable portions of distributions from retirement plans. We'll talk a little bit about rollovers, okay? Taxable and non-taxable retirement benefits, how they show up on the Form 1040, okay? On page 8.4, we're going to figure out what is qualified and what is non-qualified, okay? The term qualified is used to describe both retirement plans and other investments. From a non-technical standpoint, like that statement, a qualified plan investment is one funded with pre-tax dollars. Okay? That means either taxes were never collected or the amount invested was subsequently deductible on the tax return. Okay, so qualified means pre-tax. And as the next line says, qualified plans are also tax deferred. So what does that mean? Well, pre-tax dollars, that's where when you see on your W-2, you're contributing to your 401k. Remember that D code that we put in there? That's why that happens. Our Social Security income would be higher than what our taxable wages in box 1 would be. So that's where that happens, okay? However, tax deferred means what? The government still wants to get a piece of the pie, all right? Just because they're not taxing it on the way in doesn't mean they're not going to have their hand out looking for something on the way out, okay? All right. Talks a little bit about RMDs, required minimum distributions. So after you turn 21, there are just a few significant birthdays in your life, okay? All right. First one being 59 and a half. At 59 and a half, you do not pay a penalty for any money that you take out of a retirement account. All right. Next one, 62. We decide if we're going to take Social Security or not. 65, we get Medicare. And at 70 and a half, the government says, I don't care what you're doing, now you got to take money out of your retirement account. Required minimum distributions, okay? So if you want to tell your family those are the only important birthdays from now until you reach 100, okay? All right, and that's why you don't care if you turn 59, you don't care if you turn 60, 59 and a half, all right? And we'll talk about that with the New York considerations too, okay? And that's where we would have a penalty if we take money out. That's where Esther on her shows will just be animate. Last resort, taking money out of that retirement account to pay something if you're under 59 and a half. It just doesn't make sense, okay? The term generally is applicable to this definition of qualified. One exception is an employee-sponsored Roth IRA, which is a qualified plan, yet funded with after-tax dollars, okay? All right, so we'll see how the Roth works. Basically, a Roth, tax dollars going in, tax-free coming out, okay? All right, on 8.5, we have non-qualified. The term non-qualified is also used to describe both retirement plans and other investments. From a non-technical standpoint, we like when they say that, a non-qualified plan investment is generally one funded with after-tax dollars. Okay? So again, which one's best? You know, it's hard to say. You know, if you're lowering your tax when you're in a higher tax rate, that's good. And then you think, well, when I take this money out, I will be at a lower tax rate and it'll be taxed there. That would be a traditional IRA, okay? Roths, well, paying tax now, but when I take it out, I don't want to have to pay tax on it. You know, it all depends. That's where financial planners come in, because you have to kind of weigh, and it is a little bit of a crystal ball trying to figure out when you want to pay tax on your retirement money. Okay. All right. Retirement plan types. And we're going to do it by form here. It starts with the form 1099-R. And you will see all of these. Okay. Depending on what generation's in or is. So I have clients with 1099-Rs. They'll have 20 of them because they're just afraid to put all their eggs in one basket. And then you'll see 1099-Rs that are just from somebody's 401k or pension, and that's all they have. And then you'll see some that are a mix of both. Okay? So it just depends on how and what vehicle they use. But 1099-Rs are where you're going to see all this, and we'll talk about the coding of that. Okay? Talks about pensions there. Talks about annuities and IRAs. Okay? Everybody kind of understands what each one of those investment vehicles is? All right. I'm sure that if you've ever had a job and signed up for something, you know, you have all those different ones that you can do and contribute to. And again, you know, they match a percentage or whatever it may be. And as you're trying to make your sense of what you're doing there, you're trying to decide, when do I want to pay tax on that money? Okay.
Tim,
Yes.
question for you. Maybe there's more financial advisors. Why would somebody get an annuity other than, let's say, if they were other than like a trust, or, you know, something like that? Right?
Well, annuities can come around in a couple different forms. Annuities kind of something you put in there. It's going to be a fixed rate, and you get fixed or, you know, payments or whatever, or maybe you do variable with a balloon. Where annuities have gained a lot of popularity is whole life policies. You have half of your whole life, you know, is there, and then part of a whole life will sometimes be an annuity, so that there's money that's in there that comes out for a investment as far as retirement. So sometimes when you do those policies, life insurance policies that have a hybrid to them, they'll have a life insurance component, and they may have a annuity component where they combine a term and an annuity. So, okay. All right. So we have the pensions, we have the annuities. Okay. All right. We have IRAs. We'll talk about the taxation of it when we get into when we see the forms work. It'll be easier to see that. Yeah, kind of understand a little bit of this is a little involved as far as the finance, okay? But the big thing to take out of there is there's a paragraph about partway down on 8.7. It says pension benefits and annuity payments received before age 59 and a half may be subject to an additional 10% tax on early distributions unless the distribution qualifies an exemption, okay? So it just says will be subject to 10% except when you get an exemption, okay? We'll talk about that when we see the forms in there. A lot of time is that last one where distributions made after separation from service in or after the year the employee reached 55. Sometimes people will be offered early retirement, companies downsizing, and as opposed to penalizing them and they don't want to necessarily go back to work, or you know, they may just work part-time after 55. That's where, you know, you can have an exemption code so they don't pay that 10% penalty. See it a lot of times with large manufacturers as they're downsizing.
Is that what happened with Illinois? Big,
Delphi?
yeah.
Sometimes, yes. Yep.
I know they laid off or let go of a bunch.
Okay. All right, let's see here. We'll talk about the general rule and the simplified method when we see a 1099-R in action. Okay. The simplified method is a way for you, if it's undetermined as to what the taxable portion of a pension or a retirement distribution is, it's a way for you to calculate and determine what that taxable portion is. Because we'll show you, when I show you the 1099-R going into the computer, sometimes on the box it'll have one that says taxable amount not determined. And so we'd have to use either the general rule or the simplified method to calculate how much of that is taxable. Sometimes it bases down to where'd the money come from, okay? You know, with sometimes it's, did the employees have contributions in it, okay? A little worksheet on there, and again, I'll show you that in action in its software. Let's see here. All right, so on 811, partway down, it talks about rollovers from a qualified retirement plan, okay? So, qualified retirement plans for this purpose, the following plans are qualified for rollovers. A qualified employee plan, qualified employee annuity, tax shareholder annuity 403B, the eligible state, local, and government section 457 deferred compensation. So there's a bunch of different things that happen with rollovers, okay? First one says is a direct rollover. I work at a company, I have a 401k, I leave and go to another company. My fear is the company that I was employed at is going to go belly up. Then it's going to be a little hard to find my 401k money, okay? So what am I going to do with it? I'm going to roll it over into my new employee, okay? The Quick Finder is very good in this one. It has a little chart in here. That is a rollover retirement chart, okay? It's down on the bottom of the page here. And across the top, it has all the different investment vehicles, as it does down the column here. So you just kind of line up and say, am I going apples to apples? Or am I going apples to oranges where I got to do something? Okay? So you always want to, I always refer to this to make sure it's being handled correctly with questions. Because if I go from a traditional IRA to a SEP IRA, self-employment, okay? All right, that is a rollover, okay? All right. Traditional IRA to a Roth IRA, what must I do? Traditional to a Roth. I'm making a conversion, aren't I?
Mhm.
That's an apple and an orange.
That would be income.
Exactly. Yeah, because I just changed its tax, you know, from what we talked about with it, okay?
Tim, is this the same one that's on page 816?
As far as,
You were saying the rollover chart
is there one in there?
on page 816.
Yeah, that one's pretty good too. I don't know, that's not the one that's in the Quick Finder, but okay. All right, so we have rollovers there, and then there's also a 60-day rollover. If an eligible rollover distribution is paid directly to the plan holder, 20% will be withheld for income tax. However, the full amount is treated as distributed to the plan holder. Any amount not rolled over within 60 days to another qualified retirement plan or a traditional Roth or simple IRA must be treated as ordinary income. What that's saying is sometimes I leave a job, don't realize I had a 401k. 3 years later, the company's going belly up. They send me a check, says, here's your retirement money with 20% withheld. Well, if you want to keep it and put it in your pocket, pay tax on it, okay? If you don't, you have 60 days from receipt of that money to put it into another qualified account. Then you can avoid the tax on it, all right? Chances are you're going to have to file the return to get the withholding because they've already sent that to the IRS. But in theory, you know, if everything else works out as it should on your tax return, you should get that withholding back, okay? So that would be an instance where you would have that 60 days come into play. All right.
Withholding have to be put back in.
What's that?
Let's say you withhold 20% on a rollover. You get your rollover line. They held back 20%
Mm-hmm.
withholding. you file your return, you get 20% back.
Mhm.
But that's really part of your IRA. Shouldn't that go back in?
Yeah, you have to roll the amount, but you're going to roll over the gross amount before withholding. So you're kind of putting it back in your pocket.
Well, if you got to scrounge up the money to put the whole thing
How
on.
to collect
Yeah, and when we see the 1099-R, you think about it. If I have a distribution of $10,000 and they took 1,000 out, well, I'm responsible to roll over the 10,000. That's my responsibility. So that $1,000, I gotta.
Right.
So otherwise, you're gonna have some taxable because you're not doing apples to apples. Okay. Yeah. So rollovers are kind of tricky in that situation. So you got to make sure you know what the distribution was, and that again, when we see the 1099-R in action in the software, you'll see how that plays out, and you'll see the flow of the money, so that you see where it goes. Okay. All right. Let's see here. Talks about some of the different rollovers with beneficiaries and such. At the bottom there of 812, it says, generally a survivor or beneficiary reports pension or annuity income in the same way the plan participant would have reported it. What that means is if I'm a beneficiary of a 401k as a death benefit, I play by the rules of the person that held that qualified plan. So if they're over 59 and a half, I get to play by the over 59 and a half rules. If they're over 70 and a half, I have to play by the over the 70 and a half rules. Okay? So that's where, you got to make sure that these things are coded correctly. All right? And we'll talk about the codes here in a little bit. All right. 813, it talks about IRAs, individual retirement accounts. As we talked about, traditional IRAs, all right, they're deductible on the tax return up to a limit. Therefore, distributions from a traditional IRA are fully taxable as ordinary income. And because they are tax deferred, RMDs, required minimum distributions, are mandated by the IRS to ensure the tax is eventually paid. Okay? So, I guess that's where the term death and taxes come into play, because once you're 70 and a half, they want to tax you till you're dead to make sure that the taxes are paid. Okay? All right? Because they're going to make you take money out, make you show up as income, and have to pay tax on it. So, okay? All right. The other thing about RMDs too, if it's a formula it's based on your age and the year you turn 70 and a half. In the year that you turn 70 and a half, you have until April 1st of the following year to have that money taken out. Okay. If you are 71, you have until December to take that money out for RMDs. So there's a little different rule in the year you turn 70 and a half. Now, the 70 and a half rule, if you have to have it done by December 31st, get it done. Okay? Michelle, do you remember what the penalty is for not doing an RMD?
I know it's up there.
50%. Yeah. Death and taxes, right, Fred? And trust me, the only one I've ever gotten reversed for somebody that forgot is, I want to say it was Wells Fargo. They messed up. Wells Fargo, no. It was Discover. There was somebody that had an IRA through Discover. And for some reason, one year they decided to mail the RMD forms to couples in one envelope. So if they had two people at the same address, they folded them inside one another. And I had an older couple that just opened it and looked at it, called because of the top one, but didn't realize that the wife's was underneath, folded in. So then we traced it back that they got two of them in the mail in one envelope. Typically, they'll send you an RMD. Now, the other thing too with RMDs is it's a required minimum distribution. But if I have an RMD and I have 3 IRAs, I have one that earns 10%, one that earns 5%, and one that earns 1%. Okay? So what you do is you add up the total in your accounts that would require a minimum distribution, and then you find out how much you have to take out. Now, I don't have to take it proportionally to each of the 3. Obviously, I want to leave the 10% one alone. 5% is doing pretty good. This 1% guy, I might as well take the money out of that. So I add up all 3 of them, and I can take it out of one account.
It wouldn't be 3 separate items?
Nope. As long as your required minimum distribution, because at the end of the year, so basically for 2015, we used the total of the qualified accounts that require a minimum distribution at the end of 14. I can look at those accounts, and if I have one that's a loser, whatever my RMD is, I can take it out of that. Also, if I'm already taking distributions from it and it meets my RMD, I'm fine. Okay, understand? It's a level of money that I have to take out of my accounts. But like I said, leave the 10% guy alone. Let him grow some more. We'll take the money out of the loser. All right? So if you have anybody that has to do RMDs and they have more than one account for that, make sure that they do that. All right? So that's your RMD lesson. But again, do not miss an RMD, okay? Companies are really good about sending letters out and saying, happy birthday, you just turned 70 and a half. Here's our present to you, okay? There's some calculators that are online. FINRA has one, different organizations, bank organizations to do the calculation. And again, end of the previous year, December 31st of the previous year, you look and see what the total of the accounts is, and then for the following year, you're required to take out a certain portion. All right?
And there's no exceptions to that 50%?
Nope. Like I said, the only one I got reversed was the one with the 2 in the letter. The IRS just won't bend on that one. Okay? It's just one of those ones that there's no bending on it. Okay? All right. Okay, Roth IRAs on page 814. Contributions are not deductible on the tax return. These contributions grow tax-free by law. Therefore, qualified distributions from a Roth IRA are non-taxable. Okay? Roth IRAs are tax-deferred and qualified distributions are non-taxable. There is no requirement to take distributions. Why is that? Because why?
The tax is already paid.
Yeah, my IRS already got its money. Okay, all right. So we have that those can be done on the Roths. Okay, Roths, we'll see how they do with some different things when they come into the distribution. Still, we have some things that if you look, there's a partway down, the 10% penalty is applied to distribution with the following exceptions. Distribution of conversions and certain rollover contributions within a 5-year period, okay? Totally and permanently disabled, buy or build the first home. There's some other things in there, medical premiums while they're unemployed, okay? So we'll see, I'll show you where the codes are there and you can take it out for qualified higher education expenses. Okay, because usually my first question when I see somebody took out money before 59 and a half, what'd you use it for? Well, we needed to live. In what way? You know, and I usually say, I don't mean to pry, but if I can exclude the 10% penalty in some way for them because of one of these categories, that's pretty good. Because if they took $10,000 out to, you know, pay some medical expenses or buy their first home down payment, well, you know, depending on what it is and the taxability, but if I can avoid the 10% penalty for them, I'm going to try. Okay? All right. 8:15, there's your finance class for the day. Top 10 differences between a Roth IRA and a designated Roth IRA. Okay? All right. All right, so you can see on there. The other thing too, I see down there, then two differences, but I want to touch on is loans. When somebody takes a loan out against their retirement account, once they default, that is taxable. Their loan is taxable. And then all the rules apply, whether their age or whatever it may be, okay? A lot of times people can take out loans, and then if they're gonna do that, I make sure to tell them, have payroll deduction, make your payment back before you get your paycheck. Don't try to do it on your own, because if you forget one, they're going to say you defaulted on your loan to your 401k or your whatever it is, and then they'll turn that in as taxable income. And if you're under 59 and a half, it all of a sudden adds to your tax, and then you got the penalty. Okay?
So if they pay medical expenses, that doesn't count.
On the loan?
Yeah.
Well, if they took it out as a loan, what they did with it,
It doesn't matter.
you know, then we have to look at the distribution and see what they did with it. But loans, typically, no. Once you default on that loan, it becomes income. Okay?
I just didn't know if they would ever, like if they took it out, pay medical expenses, that would make the loan not,
Well,
not be.
yeah, but the thing is still, you know, if they took it out to do medical expenses, yes, you could, but the taking the loan out to pay the medical expenses, what you're concerned too is with it going to taxable income, because then they're getting hit twice on the tax on it. So, okay. So yeah, so you kind of gathering that taking money out of retirement accounts is not a real good idea until you hit 59 and a half. Okay, unless you can find a rule. Okay. IRA rollovers. There again, you see the rollovers, and as Michelle pointed out, the bottom of 816, very good chart, okay? And it has some little 1 through 7s at the bottom. So you can kind of use that chart and say, okay, well, I have this plan, and I'm going to do this, okay? So the following chart indicates rollovers that are permitted between various types of plans. Well, going from a Roth IRA to a traditional IRA, it says no, okay? All right, but I can go from a traditional to a Roth, but then it says on number 3, must include an income, as Fred said, okay? So you can see how we got to decide whether we have apple to apple or apple to orange, okay? And the reason I say that, you guys all realize an apple and an orange are different, right? Just because they're both fruit doesn't mean any type of rollover. Am I clear on that? Val, we clear on the fruit thing? Okay, all right, just making sure. Because I try to simplify it, but then if somebody says, well, they're both fruit. No, they're not, okay? All right, next time I'll use apples to potatoes. Okay, so that we have a strong distinction between the two. Okay, but what is that vegetable that's a fruit? Which one's the? Tomato. Is it tomato fruit?
Tomato.
Yeah. Yeah, so that's why I don't use tomato to tomato, because then somebody will really yell at me if we're going tomatoes to oranges, and they can say, well, those are both fruits, okay? All right, so there it shows the reporting of the IRAs, okay? On page 819, we see our little form there, okay? 1099-Rs, and they will, most of the time, look this way, okay? So you'll get it on that 1099-R, and the big box is obviously 1 and 2. You got to pay attention to 4. They're bolded there, and they are on the actual form. The other one we always have to look at is 7, the distribution code, okay? And then for these, when we talk about the state considerations, we're going to have to take a look at the state tax down below. Sometimes it hides down there, because when we go into the form, I'll show you how New York treats retirement accounts. Because a lot of times you have to do federal withholding on a retirement account, but not state. Okay, because there's tax-free status. New York's actually a pretty good state to retire into. On page 821, we have box 7 codes. 1 through W. Okay, not numbers, not A through W, but 1 through W. Those are all the different codes that you would see on there, okay? All right, and each one of those is handled different. Right now, New York State is picking on everybody in the T1. where it's a Roth IRA distribution with an exception applies. Okay? What I'm saying is they are finding people that maybe did not handle their Roth distribution correctly, try to make it tax-free in New York, and it wasn't. So, all right? And they're doing it from 2013. All the letters are coming out, okay? New York State's unbelievable on that. They always wait till 3 years, right up toward the deadline of amending a return. It just amazes me, okay? All right. Let's take 5 minutes, and then we'll come back for Social Security, okay? Okay. We're going to get into Social Security, okay? Yes, Social Security will be there for all you self-employed or employed Americans that have contributed to it. I don't see it going away, all right? Social Security comes on an SSA 1099. As I describe it, the one with the pink boxes, okay? It comes in that pink box one, all right? There's a publication to read there. So almost all employed and self-employed Americans are required to contribute to the Social Security system. Remember, we kind of touched on a little bit. We'll go in it deeper with the self-employment tax when we do Schedule C's. But the Social Security Administration that does this, okay? Or you may have SSD or SSI. SSD is Social Security Disability, which is handled much the same as the Social Security, but they do not include SSI, which are Supplemental Security Income. Those are based on need and are not taxable, okay? Sometimes you'll see SSI if you have somebody that, first one comes to mind is somebody through People Inc. You have somebody that really can't live on their own or lives in a, excuse me, lower income apartment complex where they have almost like a landlord that is there to make sure and that they, get to work or whatever it may be. So that they really can't live on their own, but they kind of do. So a lot of times you'll see SSI with those, okay? RRB 1099 blue form. When you have retirement through the railroad, must go back to the days of Carnegie and Rockefeller and whatever else that they negotiated this. The railroads, as a government, you did not pay into the Social Security Administration. Your Social Security was handled differently through these RRB 1099s, okay? As it says, their railroad workers do not participate in the Social Security Administration, or system, excuse me. Instead, railroad workers contribute to a system administered by the U.S. Railroad Retirement Board, better known as RRB. They're included in retirement, survivor, unemployment, sickness benefit programs for railroad workers and their families. So, it's kind of like their very own Social Security system. Just make sure you understand what the Social Security is for the railroads, okay? Like I said, we're not going to go through it right now. There is a problem in there that we may do next time in class that has the blue and the green, okay? Sorry, your workbook's not printed in color. I think we made sure that it says blue and green so that we really don't thoroughly confuse you. But you get two little separate forms from them. Enough said for right now. Okay, we're not going to. So we're going to concentrate on the SSA 1099, traditional Social Security pink boxes. We're not going to worry about blue and green. We're just going to worry about pink. Okay. Nobody in here is colorblind, are they? Okay. Just checking as I'm saying all these colors. Okay. All right. 823. We see our SSA 1099. Looks just like that, but like I said, some of the boxes will be pink. Okay. And it comes in one of those envelopes that you have to tear off the sides, which for anybody that has arthritis is just about next to impossible to break into. Haven't figured that one out either. That's just torture. So if you're on Social Security and have arthritis, chances are they just hand it to me and say, here. okay? Or I get them, and it looks like they had the dog chew off each end. All right, okay? So, yeah, to me, that's just torture when you're doing that to somebody that maybe has arthritic hands or they've worked with their hands and their hands just won't work those things. So, all right. And the other thing is, if they put them together, make sure you double check that you only got one, because then they do that thing where they got that little gum that the envelope closes on, and sometimes they'll stick to the back of each other and you don't realize there's two. So always make sure that you pull them apart, because that little gum that they close the envelope with, that all over, yeah, they'll stick together then too, okay? All right, so down at the bottom of 823, it talks about our different boxes in our 1099, or excuse me, SSA 1099, okay? Box 3 there, it says benefits paid, all right? The description will contain the total Social Security benefits and any adjustments, including the total amount of Part B, Part C, and or Part D. Medicare premiums, which may be deductible as an itemized. So again, that's our gross benefits, okay? That's the number we're going to work off of. Box 5 is net benefits. The figure in this box is the net benefits paid to the recipient during the year. If more than one form SSA 1099 was received, add the amounts in box 5 of all the forms to determine the net amount of benefits for 2015. Box 6, if we have tax taken out. Okay. Again, take a look at the ones with the railroads. Understand the difference between the blue and the green. We're not going to get into them because, as we do on calculation, I tend to have students get their wires crossed as to where they're putting things. Okay. So we'll do a problem together on that one. All right. On 826, there is a little sheet that says, worksheet that says figuring your taxable benefits. Depending on how your tax return works and the income sources that you have, you could have up to 85% of your Social Security taxable, okay? A lot of people will come in and say, oh, I just have Social Security, but it's not taxable. I didn't bring the form. It's not true, okay? And yes, that Social Security money typically is what kind of money going in? Taxed, isn't it? If you think about the W-2, it stays on there even though we subtract retirement and we don't lower it by what we paid into the Social Security. It's money that's in our gross income that's taxed. And then up to 85% of it could be taxed again. Kind of sounds like it's taxed twice, doesn't it? So as we're all getting ready to retire, thinking this, retirement's supposed to be easy, okay? Now they're taxing me and they make me and pay this and pay that, and I got to be taxed on this and that, okay? So there's a simpler sheet, if any of you do receive Social Security. On the back of the funny little envelope and the way it's folded, there's a simple little I'd say there's about 8 lines on it that you can use to calculate if your Social Security is taxable, okay? So if you've ever seen one of the 1099 or SSA 1099s on there, there's a simpler little form other than the one that the IRS does that you can, see what of your Social Security may be taxable, okay? And that comes with your statements you get for your tax year. All right. Okay, we're going to skip the green form there because that on 829, as it says there, what's it say at the top? Be aware, okay? All right. Okay. And we won't worry about the civil service ones. Okay, so here's what we're going to do so that we can talk about these. We're going to do on page 79 of your workbook, we're going to do Elmer and Elizabeth Jones. Okay, so why don't we go ahead and start getting the information in there. The bio is pretty simple and straightforward. Elmer and Elizabeth filed a 1040A, which tells us what? Did not itemize. Okay. They're filing a joint return. If they get a refund, they want it in their checking account. All right. If they owe anything, we'll have them send a check. And then it says, use the information sheet to complete their return. And both Elmer and Elizabeth had health care the whole year. All right. For the check thing, like I said, for some reason, those little information sheets are dropping the 0. If you ever have doubt, use the M&T one, 022000046. For some reason, the information sheets, every one of them dropped the first 0. Okay. So we're going to start. We're going to get these guys in here. And this time, I promise I won't forget to put the wife's social security number in there. Okay. Just so you know, if you did that, if you went to do diagnostics to try to file the return, it would have lit up red and screamed at you and said, this doesn't work. So, all right. We got Elmer Jones. And we have Elizabeth Jones. Okay. And make sure you put her number in there. All right. They are living on River Oak Drive. Sounds pretty. And the Joneses are keeping up with the times. They have an email. Yeah, I know. They're doing pretty good, aren't they?
They're not good.
But depending on the age that they are, I bet they still have a flip phone. Which is what I wish I had, but they always want to get a hold of me, so. We got 50 and 57, right?
65 and 58.
No, the years they were born.
Oh, yeah.
Okay. They're doing a married filing joint return. One is retired, one is semi-retired. Okay. Nobody knows households like that, do they? All right. Married filing joint. They lived in New York. And as I said, we'll kind of go through some of the things that happens with retirement income when we do this one and talk about the New York side, because New York's actually a pretty good state to retire in. Anybody here previously First Niagara and had to make the transition?
Yeah.
How's it gone?
Oh, not well. You too?
Not me. Nope.
I tried to get out of Northwest Bank, but they won't let me. I don't even have any money there. Sending me some.
Yeah, I know that has to do with the monopoly laws that they had to divvy up the accounts so that, I forget how it works. There's a bunch of weird stuff on there. All right, so on the 1040 page 1, we're going to check no, they did not itemize. All right. Yeah, I'll do the New York stuff here a little later. They had health insurance all year long. If they're on Medicare, they'll get what's called a 1095B that'll show the months that they were covered by Medicare. Nothing you have to put on the return like a 1095A, but a 1095B would show from the Social Security Administration or the Medicare Administration that they were covered all year long, so that you'll know, okay? Otherwise, the SSA 1099 would just show a Medicare payment, but it doesn't show you how many months. So you have to get that little extra form, okay? All right. So looks like Elizabeth's still working. So let's put her W-2 in. She's working at Nutty for You. No, I don't make these up. And that's on Main Street. And her little job there is making $11,548.33. And $500 in withholding. And as I said, they lived in New York all year long. Not snowbirds. Okay. All right. And let me know when everybody's there, and then we'll start with our first 1099-R, okay? Who's through the W-2? Everybody? Okay, give a couple minutes here. All right. So on the 1040, page 1, if we go down to lines 15 and 16, we can see that we have IRA distributions, taxable amounts, rollovers, whole bunch of stuff that shows up on the 1040 there for 15 and 16, okay? But what we're going to do, doesn't really matter, go into one of the fields, click on our link, and when we get in there, we're going to see new 1099-R. So we're going to check that. Don't worry if it's on the right line or not. The form will take care of that, okay? And we'll talk about that here in a second, all right? So we have, at the bottom of page 81, we have a 1099-R for Elmer Jones. And it's from my pension, okay? So we're going to click the box. This is for Elmer. And it is terribly important that you get the right taxpayer or the spouse, okay? Tenfold more important than the W-2. And I'll explain why when we get to the New York, okay? All right, just like we do on the W-2, and check the box to make sure the address is correct. Again, this is coming from my pension, so we put the EIN number in. And my pension is right down the street, apparently, from Nutty for You, 65 Main Street, okay? That must be why Elizabeth's there. She's keeping an eye on Elmer's pension. All right. Okay. Now, as you can see here, if you take a look at your gross box 1, what's in there? What's the little thing after the parentheses? What's it say in there in the 1099? It says gross, and then what's in parentheses? Where's, yeah, okay. See why I don't try to teach you both at the same time? Because the RRB is what type of pension?
Really?
Yeah, but it's their Social Security. But it's not showing up on the Social Security page. Okay, so see why I don't intermingle? Because then you're going to go, wait a second, doesn't that, okay? So right there in parentheses. So that's why I say I don't teach them together. I want you to understand the Social Security. I want you to understand the 1099-R. Then we can confuse you. I'll throw it on top, okay? All right? Yeah, I'll confuse you later, okay? But we have our, we have up here our gross income of 15,000. All right. And it says that we're fine there. See where that little box says taxable amount not determined? Sometimes that'll be checked if they don't know what portion of the distribution is taxable. And we'll talk about that in a second as we work our way down. In this case, the taxable amount is the same, 15,000. Okay. All right. Make sure you get that tax withheld, 1,500. None of this was any contributions to anything that, or designated Roth contributions. All right, so nothing there. Here's where our code comes in. Just like we have in our book, we can do an F1. And it's not going to let me, there, no. Well, that's not good. Here it comes, lighten it up. There it comes. Okay. That was just a little slow. Okay. Nope, there it goes. All right. Anyway, I'm not going to mess with that because it's just going to fade in and out. In that box 7, if you hit F1, it'll show you pretty much what we saw on that one page with the codes. Okay. In this case, code 7, typically that's what you see, normal distribution. All right. Remember I said that the 2 lines on 15 and 16, this is where that comes into play. In this case, we're not checking the IRA SEP or simple. Okay, so it'll leave it on the pension line. All right, so we're not going to check that. All right, and if we look down at the bottom, he had no distribution on the state. Okay, now, next to the making sure you get the right taxpayer of the spouse, this is the 20-fold important box, okay? See over here where it says box 1, box 2, box 3, and it says on the state return for use of these boxes, instructions vary by state, all right? Okay? Hit F1. I'm not going to do it because my screen's not working for some reason. Okay? And let's see, scroll down a little bit there for me, Tim. Let's see if they still have it in there. On down. Oops. Keep on down. Yeah. Keep on down. Didn't have it on here. Keep on down. Okay. These boxes are for different things that we do in the state. And then obviously one has what? Railroad retirement, okay? Box 1, we are going to check if they are over 59 and a half. How old is Elmer? We did on the main info, it was, okay? So I want you to check box 1. All right? Okay? Now, what I want you to do next, and I'm going to explain why we do this, is I want you to go to your New York 201, page 2. Okay? So New York, IT 201, page 2, and scroll down to these subtractions. Okay? This is what I mean by the fact that New York State is very friendly, okay, for retirees. But only if you do your job where you get the taxpayer spouse correct and you check the right box over there. If I check box 1, I am going to get my pension and annuity income exclusion. Okay, so any money that comes from a retirement account, basically, all right, is going to be there. What do you see on that line for you? 15,000, okay? And it says, if the taxpayer reached 59 and a half during 2015, enter any adjustments needed on line 29. This used to do this to prorate it, because if I was born in January, I turned 59 and a half when? sometime in June or July. Okay? So you got to kind of do that. In that case, they would only get half of the exclusion. But what this is saying is, in New York State, the taxpayer and the spouse get to exclude the first $20,000 of retirement income once they're 59 and a half. So you can see why on 1099Rs, you got to make sure that you get taxpayer and spouse because they each have a 20,000 exclusion. And then we got to make sure we check our box, okay? So box 1, 59 and a half. All right? If you got to post it or someplace in your book, you might want to write this down and then stick it to your computer when you get to wherever you're working, okay? Do not forget those boxes, okay? Now, box 2, I won't go back to it now, but box 2, if this was a government pension, I would check box 2, all right? Box 2 falls under line 26, pensions of New York State and local governments and the federal government. If this was that, and there's no limit on how much government pension can be tax-free. So that's why I say retiring as a government person in New York State, and if your pension's $75,000, not one taxable dollar on it in New York. Okay? But in this case, box 1, okay? All right, so see how important the taxpayer and the spouse, and then make sure you check those boxes. So let's go back to our 1099R. So go over on the tree. This is the one that says 1099R, and then it says TP for taxpayer. And this is the one for Elmer, okay? So we're going to scroll down a little farther here because there's more to the form. We got our box checked, okay? All right.
And what was box 3?
There is nothing for box 3.
Oh,
Just worry about 1 and 2. 1 is 59 and a half. 2 is government. Okay? All right. Now, if we look down at the very bottom, see our little exclusion worksheets and our simplified method. If you look in these are things that we can exclude taxable income. All right? We can exclude taxable income that shows up on our 1099-R. Obviously, what's the first one there? If it's not coded as a rollover, we can say that we did it within 60 days and show that rollover amount. Okay? All right. We have some things up there that, roll over into an HSA. Then if we have something where we converted, remember we were talking about that chart? You can see here where we're going apples to apples, not apples to potatoes, okay? Excludable amount due to tax-free exchange as calculated in a previous year. So if there's something that we did with a conversion, we may have to put it down there because the distribution may not be coded the right way up at the top. We can do the exclusion down at the bottom, okay? Down here at the bottom, all right, we have where we can do the simplified method. If up at the top, it says taxable amount not determined, that box would be checked. And if that box is left empty for taxable amount, I'd come down here to the bottom to calculate, okay? So on this one, let's give it a try, okay? So what I'm gonna go do, and don't do it on yours because I want you to leave it right for yours what the problem is. I'm gonna go up and say taxable amounts not determined. So I'm going to put a 0 in there for that taxable amount. If I go down to the bottom, I'm going to put in my 15,000, and then I'm going to answer my questions. Checks the age of the primary annuitant at the annuity start date. Well, he got this when he was 65. Okay? You can see a little factor comes in there, an exclusion of per month because of his age. And he gets it paid every year. All right, so see how the amount that's taxable is calculated based on their age. Okay. All right. Okay. Everybody see how I did that? No? Okay. So up in the top, if the taxable amount was not determined, we're going to put the gross distribution, the age when they started getting it, and then how many months in the year that they received it. Because typically you get retirement accounts monthly. So then it made and it calculated $14,250 is his taxable portion. All right. Okay. Once you do that, if I go back over to my 1040 page 1, I can see my distribution, 15,000. But what's it show for my taxable amount that I actually have to show on taxes? 14,250. See how I carried it right over there for you. All right. You don't have to go put it up in the taxable box. It takes it right over for you. Okay. And we'll do more of these. Okay. But I just want you to know, if you don't know the taxable amount, don't panic. You can use your simplified method at the bottom. You know what the distribution was. Find out their age when they were starting to get it, how many months they got it, and it calculates it for you. Nothing more, any simpler than that. Not one of those deep involved IRS worksheets. Okay. All right. So I'm going to go put this one back the way it was. Okay. All right. So turn over to page 82. All right. And I want you to put Elizabeth's in. So if I'm on my 1099-R, I can just go up the top, hit copy, and I want you to go ahead and put this one in for me, okay? Because why? What's wrong with her? How old is she? When's her birthday? So she wouldn't have reached 59 and a half, would she, during the year? Shame on her. Okay. What's that?
She took money out before 59.
Nice round number like 10,000. Sounds like Elmer and Elizabeth bought a new car, huh? Or Elizabeth bought a new car and didn't tell Elmer. Okay. Have been known to have that happen. Where there's one spouse and they can't figure out. Okay. So at the top, and again, this is why it's so important to check at the top, because we know this one is for the spouse. Why is that important? Yeah, exactly. We make sure that it pulls her birth date from the main information page, so that even if we accidentally check the boxes at box 1, it's not going to give it to her, and we'll see that, okay? So we have that. We have the payer's ID for this one from Harder. I have no idea what Harder Company is. Okay. Oops. Okay. Okay. And we have 22 Main Street. Everything's right together. This must be what's that place? Dixie Notch or whatever it is, where there's 6 people. Everything's within the same building, apparently. Okay. She took out $10,000. And we don't have any boxes checked about the taxable amount or total distribution. Okay. Taxable amount was $10,000. Shows that it was a code 1, which means normal distribution. And it was an IRA. And then remember, whenever somebody takes it out early that's not 59 and a half, chances are taxable on the state. And in this case, you can see down at the bottom in box 12, there was some state tax withheld. Okay? Kind of sneaks up on you down there. It's one of those ones that sometimes you get so used to not having state withholding. All right? Okay. And do we check box 1?
Nope.
What if I did it by accident? Because I'm so in habit of it. If I go over, and even though I checked box 1 saying that she should be exempt on the state, did it show up? No, just Elmer's 15,000. That's why I say it's so important at the top of 1099Rs to make sure you get who it belongs to. Because the computer knew she was not 59 and a half. Okay, so even though you might get in the habit of every time you get a 1099R checking the 59 and a half box, it's not going to do it. Okay?
So you get a diagnostic, or is it just?
You might not.
I don't know.
You might not. You might not. So, all right. So we're going to uncheck the box for that guy. Okay?
Assume no box applies to her then.
Exactly. Exactly. Okay? Yep, no box applies to her. All right. Okay. Now, they had a nice little refund, but all of a sudden now, uh-oh. Yeah, I hope she told Elmer. Otherwise, he's going to be mad when he comes sees me. Okay? Now, after you get in there, I want you to go on your tree and go to the 5329. Okay? And what's it say at the top of that? And other favorite accounts. Okay? This is typically when we do a no-no and take money from something that we shouldn't have until we qualify. This is where the tax is going to be calculated. We'll look at the rest of them. But additional tax on early distributions right out of the gate. What do you see in there for her? 10,000? Okay? There's the penalty. So she's got a $1,000 penalty. Okay? Now, right here, okay, is where we would put in that, just the exception number. Remember I was talking about the ones about, you know, say that they took it out to pay medical or whatever it may be. That's where you would put that in there. Okay? Let me see if my F1 box will work here. No, it just gets dark. Okay? All right. So go in that box and hit F1. So see we're on the 53. Is everybody on the 5329? So go to your tree and go to that 5329 form. Okay. And then hit F1 and scroll down. Okay, part 1. Oh, there you go. See where it says exception codes? Click on that one for me, Tim. All right. And you can see there, that's what you would put in there. And those are the codes for all the different things. So if you have somebody that comes to you and says, we took 10,000 out as the down payment, and it gives you a little more description too. If you go down to the one right there where it says 9, IRA distribution made for the purchase of a first home up to 10,000. So it does help you out. So if somebody has 20,000 they took out as a down payment, what can I exclude? 10. I can help them out a little bit, but I can't get rid of it. Okay, so you see those codes are in there. All right? So all those different codes would apply so that I could try to exclude the money. Now, while we're on this form, if we scroll down a little bit, you can see part 2, we have some things for additional tax on certain distributions from education accounts. Part 3, we'll talk about this when we get adjustments to income, but there are cases where you can put too much money in your traditional IRA. And the government's going to penalize you for funding your own retirement. Okay? As part 4, excess contributions to Roth IRAs. So if you're too good a saver, the government's going to get you. If you go to page 2 of the 5329, if you're saving in the Coverdale for your child's education and you put too much in there, they're going to tax you. Okay? And then also, we'll talk about this with adjustments to income, but you see on part 7 there, health savings accounts. You put too much money in there. Okay? All right? So you can see all the different things that we can end up. And at the bottom, Roman numeral IX. What does it say? Additional tax on excess accumulation and qualified retirement plans. What do we think this is? This would be the RMD death squad, okay? Because what's it say at the very line? 55 says additional tax due, multiply line 54 by 50%. So half of whatever you were supposed to take out, the government gets. See why I say that you won't want to miss those? Okay? All right. If the shortfall in the amount of distributions was due to reasonable error and the taxpayer is making reasonable steps to remedy the shortfall, you can request a waiver of tax. Link here for a waiver explanation. Has a little sheet that it goes there, and that's where I typed in for that couple. Here's what happened, and we have documentation and a letter from Discover saying that they did this. Okay? Or, you know, maybe something came up, somebody ended up in the hospital or whatever, and they remedied it by June or July or January 3rd. Maybe you can put in and see the IRS, probably depending how good the mood of the person is that receives it. Say, okay, well, Elmer and Elizabeth seem nice. We'll let them slide this time, okay? But I guarantee if this happens more than 1 year in a row, yeah, it has to be an exception, okay? So you can see there, don't want to do that one, okay? All right. Okay, so that's the 5329, okay? Let's see, what else do we want to do off the 10? Oh, if we go back to the 1040 page 1 and we come down, all right, to lines 15 and 16. Remember how we checked the box for the IRA? Now you can see them on the 2 different lines, okay? Now, what we're going to do with this one is we're going to determine that Elmer didn't know that Elizabeth was taking it out. He caught her within 60 days and told her to put it back. Okay? So, we're going to treat it like a rollover, okay? Because she rolled it into something different, we'll say. All right? So, we're going to go to our little exclusion worksheet and see where box 1 is. So down 1099R, go to the bottom. All right, on the one for her. And we're going to put $10,000 that she rolled over. She took this money out, and actually she didn't buy a car. She put it somewhere else so that Elmer wouldn't know about it. But it was another retirement account, only in her name at a different bank. Okay, all right. Please don't try this on your spouse. I'm not giving these ideas to you to hide money from your spouse, okay? This is just an example. So, down at the bottom, even though it was coded 1 up here, this could be a case where she got this $10,000, didn't know she had it from this Hartar company, and she's decided that within 60 days she's going to put it into a qualified account. And we would have documentation. She might get a letter that we'd have to show the deposit. Sometimes you have to get the statement that shows that you opened the account. Because if it's coded 1, we know that it's taxable with a penalty. But in this case, we're showing it as a rollover. She took that money and put it somewhere else, okay? If I go back to my 1040 page 1, all right. Okay, see what happened? 15B, there's the box, says a rollover, and it checked the 10,000 and took it out of our taxable column. So where else did it probably disappear from? 5329. Okay? Because there's no penalty on it. All right, so that's the way it'd roll over. Rollovers would show code R on there too for rollover in the code box. You don't have to do anything special with those. But if it's a case where it's a normal distribution, like I said, left this job, got this 10,000, didn't know it was there. She gets the check. She takes and rolls it over into something in a timely manner, according to the law. We'd have to put the 10,000 there, and then it shows a rollover. Okay? All right? So see how that rollover works, that it's not taxable in this case. Okay? All right. And the last thing we have to put in, so I'm going to go and so go back to your 1099-R for her and take that 10,000 out. And before you take it out, did you look at your refund box? What's it show?
2532.
Whoops. Yeah, you're right. I forgot my tax withheld. Okay, so we're 2532, and I'm going to take that rollover money out, make it a 0. Okay, what'd it go to?
So if you take the rollover out again,
We're going to take it out of box 1, so we're going to put it back the way it was originally.
you're only getting $532 now.
Did two things, didn't it? Penalty and increased their tax bill by $2,000. Okay? All right. Last thing we have to put in is the bottom of 82, we got a Social Security statement for Elmer. So we're going to go back to 1040 page 1. We're going to go into the Social Security, the 20A. All right. And what are we going to go into, Fred? It's a worksheet.
The worksheet.
Okay, all right. You missed your cue, Fred. You were good earlier. All right, so we got a worksheet. Of course we got a worksheet, all right? Make sure, again, put it under the correct person. We got a taxpayer. Elmer was getting from box 3, $10,760, okay? And he has Medicare withheld of $1,248. And he had $300 in taxes withheld. Okay? All right. So we got that in there. Okay? Now, after you get that in there, we'll go back to the 1040 page 1. And if we scroll down to line 20 where our Social Security shows up, 20A shows the gross distribution, $10,670, but because of the income up above, only $49.42 is taxable. Okay? All right? So you can see how the taxable amount and the distribution is different. In this case, married filing joint, roughly half of their Social Security is taxable because of their 2 pensions. All right, so little financial planning. All right, I'm going to go back to the 1099-R for Elizabeth. She got it from her employer. And I'm going to take that 10,000, say she rolled it over. Okay? Rather than keeping it. So that 10,000 is now a rollover. What did it do to Social Security? Well, none of their Social Security is taxable. So when she took that 10,000, not only did she create a $1,000 penalty, $10,000 of more income, she also created $4,900 of Social Security taxes. And that's where taking that money out before you're 59 and a half. Hello? Teaching? Okay. All right, so see how the impact of things like that? A lot of times we'll have people come talk to us and say, hey, we're going to take $10,000 out of one of our accounts and we're going to buy a new car because we want to drive the country now that we're both retired. Okay? Well, you're both over 59.5, okay, well, we can avoid the penalty. But that $10,000 might not just be $10,000 of additional income. It may result in taxable Social Security. So we went from a refund of $279 back up to a refund of $2,832. Okay? So you can see the tax hit that those retirement accounts can make on your income. So that's why when you're under 59.5, do not touch. Okay? Has to be extreme circumstances. And then you can hope that it's one of those extreme ones that you can exclude. Okay? All right. Any questions on retirement accounts? Or penalties? Or apples and oranges? Or any of the above? Okay? All right. So, we got done a little early. That means you guys can go vote. All right. Okay. Let's see here. Yeah, A2 does, yep. And 8.3. Okay. Yes.
In that Social Security benefit statement, that Medicare 1248, where is that supposed to go?
1248 on your Social Security, on your worksheet 1.
On the worksheet one, okay.
Yep. We have our little lines. Social Security received, or box 3. Then you go down, it has a Medicare parts B, C, and D. Do you pay for A?
No.
No. So this is part B. Okay?
Part B,
Yep. And that's the 1248, and then the tax withheld. So those will all flow to the right spots.
so the 1248 is part A.
Part B.
That's part B?
Yep. And that's where if you go out and get a supplemental where you're paying premiums on a Part B, where does that subtraction go to? It goes to the insurance company. They'll pay for the premiums that you may have because it's coming out of your Social Security. Okay?
Yeah.
So, and then if you have anything over and above, let's see, right now, Part B is what, anybody that retires now from Medicare, I think it's gone up to 121. It used to be 104, but it's gone up to 121 a month. So that's basically you paying your premiums for your B. Now, if you get your B as a C that has B and D together, Val's laughing because I went through this with him. And he had the same look on his face, okay? All right?
So you'd see nothing in,
Well, you'd still see it because you pay the B out of your Social Security, but then you're credited that when you're buying your supplemental and getting a C, which covers B and D, because it covers the gaps in B and D. All right? And if you want to go to AARP, they have A through L as part of your B that covers your C, that's C and D together. You want to write that down, Fred, or are you just going to nod your head? You got it? Okay, all right. And if I have to talk to you about it, where do I send you, Val? To Brian? Yeah, to Brian Janik. Okay.
One more question.
Sure.
On the exclusions on the health savings account.
Mhm.
How do you determine how much is overpaid? Is that something you have to look out?
When we do adjustments to income, we'll do that. $3,300 per individual, $66 for a family is the maximum. So if your employer is contributing and you contribute, and we do, when we see the adjustment to income, when we do the worksheet in there, if the two of you add up to greater than the limits, that's where there's an excess contribution, and that's where you pay the penalty. Okay? Got it. Same thing with traditional IRAs when we do adjustments to income, because those contributions are lowering our adjusted gross income. When we do adjustments to income, it's lowering our adjusted income before we go into calculating tax. Remember back when that one chapter talked about credits versus deductions? Adjustments to income are really things that are lowering our taxable income. Well, if we're cheating there, the government's going to say, you can only do this because we're not going to let you take that away just because you can't do it over here. Because they're not going to let you cheat because maybe you don't have credits, maybe you don't have earned income, maybe you don't have kids in college, no children. But they're going to limit you. Okay? All right. Any other questions? Yes, Fred.
Think about the additional tax on that excess IRA contribution.
Mhm.
So that be, you can contribute up to 5,500. So let's say somebody puts 5,500 in, but they're not allowed to get a deduction for the whole amount based on some other requirement on something.
Let me show you that. Okay. If you go, and I'm going to do, I'll show you on this one because it's kind of similar to what Val was asking about the HSA. So if I have my IRA deduction, it's the bottom of 1040, page 1, adjustments to income. And if I go into that square, what is in there, Fred? He missed his cue again, didn't he?
And the,
What?
on the last return I got.
No, if I go into the square, what am I probably looking for? You missed your cue again, Fred. There you go, thank you, okay? There's a worksheet for me, all right? Okay, good answer. So I have my deductible and non-deductible IRA worksheet, okay? If I go down to my traditional IRA, it tells me based on the ages that are there what my maximum is. So if you look at line 9 on that worksheet, okay? So if you want to follow along, go to your 1040, page 1, go down to line 32, and then link to in that box, my IRA worksheet. Okay? And if I scroll down a little bit on that, it shows my traditional IRA. That's what this section is. It says traditional IRA allowable 6,500. Well, again, Elizabeth's hiding money here. Okay? So she is going to make a contribution of that $10,000. She's not doing a rollover. She kind of cheated. Okay? What's it show there? After I put that in there, what shows up on line 13? Excess contribution, right? Because that 10,000 is 3,500 over the limit. Okay? That being said, I go to my 5329 part 3. So go over on your tree, your 5329. I go to part 3 of it. What calculated?
3,500.
But what's the very bottom number?
Oh, $210 extra tax.
That's her penalty. Okay? So chances are that 210, if it gives too much, probably negated the tax benefits of contributing to my IRA. Okay? All right? And 2, you have to look at that if there's combinations. Say that she was doing a 401k at work. Well, that takes into account that too. Because sometimes somebody will go, well, we're going to get 5,000. I'm like, why? You're not getting any tax benefit. They said, well, don't you get to deduct that? Yeah, but you're already giving it work. It's either going to show that you're under the limit and it doesn't benefit because you're under retirement plan work, or it's going to result in excess contributions to retirement accounts and may result in a penalty.
So it's better to work this all out ahead of time before you make the contribution.
Thus, the what if mode, okay? Because as they're doing it and you get all done with their return, that's where you can say, well, yeah, you can put up to 6,500, but my suggestion is only 3,000. Because I will see where, they get to a point and 3,000 might be the limit. I could put in 4,000, 5,000, 6,500, but anything above 3,000 doesn't gain them. You know, that 3,000 and below gets them that extra on the refund so that it makes that money stretch. But if you put in 4,000, you basically just locked up 1,000 for no reason. Unless you're, you know, like I said. But, you know, that way you can say to them, no, just put 3,000 in, you get the tax benefit. Take that other 1,000, do something else with it if you want to put it away somewhere. But on your tax return, it's not going to get you anything.
It looks like it'll get you an extra tax bill too.
Yeah.
Oh.
Yeah.
So you just, if you just estimate and figure like, yeah, 5,500, you could actually do yourself a lot of harm.
Yep. Like I said, a lot of times when we do those adjustments, we do that, and I'll talk to you about health savings accounts and IRAs. You know, health savings accounts, I always tell everybody when I'm doing health insurance with them, $1,000 for every 1,000 that you put in a health savings account, it might gain you about 150 on your refund. So when I take that 1,000, subtract that 150, I funded my health savings account with $850 and got $1,000 worth of medical coverage. That's good. But if I get too much, then it's the other way. That $1,000 might cost me $1,250 to put in there. That doesn't make any sense. Why would I spend $1,250 to get 1,000? So that's where you got to make sure on those contributions. So just because there's a limit and you think you can get right up the limit doesn't necessarily mean it benefited you. You got to be careful. All right. Any other questions? And the HSA, Val, very much the similar circumstances. Okay. All right. So the moral of the story is, don't take money out of your retirement account unless you talk to your spouse. Okay, in this case, Elizabeth's sneaking around behind Elmer's back. It's costing them money. Okay. And, you know, we may say that kind of tongue in cheek, but like I said, and I think I might explain this, I've worked with a guy and we're trying to settle now with New York, but his wife was ill in Roswell for 3 years with cancer. And she had always done the tax returns, always filed them, he just signed them. But because of the poor health insurance she had, she was taking money out of her 401k to cover her bills and didn't want to burden him with it while she was alive. Well, she passed. He discovered those 3 years she had filed the return but didn't pay any of the tax. And then he was just kind of on his little part-time job after she passed and didn't have the money to pay the bill because she was under 59 and a half. So, you know, we had to put in an offer and compromise and explain the situation, and it's ended up in a non-collectible status because he's just not going to have the income. He's even started to draw Social Security and just has no way to pay these tax bills because you can see how they can snowball when you're taking money out of that, not only taxable income, but the penalties. And if there was no withholding on the tax, then you're really talking about money. So, and like I said, it's not, you have to really seriously weigh, you know, taking money out of that retirement account because that money will cost you something to do. You may be better off trying to take a loan or go to the bank and get a loan. You know, it sounds like, well, why do I want to pay 3.5%? Well, I guarantee on your tax return, it's probably going to be greater than what the interest rates are at loan at the banks right now, or the interest rate that you might get on a loan to your 401k. As I said, with those loans to your retirement account, don't default because then it goes right to income and then you see this happen. Okay? All right. Any other questions? Does anybody not want to retire now? It's supposed to be easy, right? Yeah. I love those people that say, I'm 65, I don't have to file taxes anymore. So, all right. Maybe when you get to 80, you might be in that scenario. So, especially if your RMD's been in there for a while and they've cleaned you out. So, okay. All right.